advice or recommendations for any individual or on any specific security. Before acting on any information, you should seek independent financial advice. All securities and financial products involve risk. The information is given in summary form and does not purport to be complete. While due care has been used in the preparation of this presentation and the information contained herein has been obtained from sources believed to be reliable, its accuracy and completeness cannot be guaranteed. Forecasts and hypothetical examples are subject to uncertainty and contingencies outside of Willow's control. Past performance is not a reliable indication of future performance. All right. So
I just had to ask Paul quickly, did you see the retail numbers, sales numbers this morning?
Did they come out this morning? I have not had a chance
They
to
were at an all-time, not an all-time high, but they definitely beat, but it's got to be, I don't know what it is.
The interesting thing with retail sales numbers is it's tracking the notional value of what's been bought or sold. So when you look at inventories, inventories have actually been going up, meaning that less product is being sold.
But for higher prices.
Exactly. So less things are being sold, but right now they're commanding higher prices.
Exactly.
It doesn't historically bode well, right?
It's so funny. They just love to play these games. Okay, risk metrics. Let's take a look.
All right.
Nothing,
first one.
Very quickly, nothing seems to be showing up, right? So
overall on those things, I do want to make one mention of this yield curve because I've been doing a lot of research around the idea of what's called a bull steepener, where the short end sort of stays flat for the most part or comes down, right? Bull meaning a bull market, and bonds meaning that yields are coming down, but prices are going up. So the yield is coming down, but it's coming down faster on the long end of this curve, which we can see here, right? 1 year ago, 1 month ago. It's a much larger move than on the left side of the graph, where the short end is, where it's only come down a little bit. Historically, that is not a sign of economic growth. That is really coincident historically with recessions in the past. And what it's ultimately saying is that there's less confidence going forward that growth will materialize. To be seen, but this is definitely telegraphing something.
Yeah, so just so you know, I had I'll share this with the group here, but this is unprecedented that we see these yield curves inverted for such a long time without a true declaration of a recession. And we say this over and over again. I just want everybody to know I was on the phone last night with an analyst out of Australia from 9:30 at night to 11:40 because I was so intrigued. But she's of the mind. She lives in Perth. That's the best area of Australia in terms of economic growth. However, the country is in a recession. It's just never been declared. So she was an analyst here in the United States too. She says, we've been in a recession. We know this, Paul and I say, it's like a reverse stagflationary environment where the prices of necessities are going higher. And depending upon where you are, if you're on a fixed income, you are feeling the effects. You are in a recession. I mean, let's just call a spade a spade. And in the lower income brackets, they're in a recession. So these are truths that are taking place. So despite this inversion and not showing it in the numbers, we don't buy it per se.
Yeah, here's the bond spreads that we track. The more risky are starting to tick up a little bit, but nothing here is, waving red flags saying, hey. Same here with different industries, and they're BBB rated, so it's sort of that middle ground of risk. These spreads would really start to blow out if thoughts of default or risk for these companies and sectors really started to increase. We're really not seeing that. To note, though, people sort of have just stopped talking about all the CRE stuff, which is interesting. But that orange line there really shows the financial
commercial
sector.
Real estate.
Right. And so commercial real estate would be part of that, including banks and medium, small, mid-sized banks as well. So you can see there is still elevated risk in that sector. It's come down.
I think we're just not seeing it in the numbers, what we typically see, which is very bizarre. You can keep scrolling forward, Paul, while I talk about this if you want. But one of the things that we watch is the senior loan survey. And the senior loan survey continues to show that there's stress in the commercial real estate market. And then also this month, the print for auto loans was really bad. So.
Yeah. So looking at the past two charts, just credit default swap spreads, risk of countries or governments going belly up, right? What's really I found interesting with this chart here is I remember when I first started looking at these things 15 years ago or so, and the United States was consistently top three.
It'd be Germany, and Germany would be up there, and Switzerland
Mhm.
would be up there. Those were the
Yeah.
top three.
And
And
Germany and Switzerland are still one and two, and yet
yeah,
now the United States is 16th or 15th or 16th on this list.
yeah,
So what
way
this is
down.
saying is the risk of these countries defaulting, right? This is probably a byproduct of our current debt levels, which no one's really talking about, and just continue to compound and increase at a truly unsustainable rate. I have a chart that shows that later that we'll dig into
Which
too.
which which brings us to this point. Paul and I like Switzerland.
Mhm.
We like it as a safe harbor for your money. We will likely be taking for where it's appropriate. We will be taking a position there in Switzerland in bonds. We feel it's a really good hedge against the dollar and against this debt. Now, this is something, so you know, this lower ranking for the United States was completely predictable after the financial crisis because we started to print a lot of money and we took the debt on from private industry, like the bailouts, and put it on the federal government. And we've just been spending like a, mad sailor for many, many years. And so this to us is predictable, and think actually that we will see it go lower. So this is not a shock to either one of us at all.
Yeah, and it government regulators are telling us too that this is going to continue. When you look at the CBO's reports on where they see tax receipts versus interest expenses, returns, all these different
Mhm.
things, there's this massive gap. And when you look at their charts, these are the charts that they put out there, and the thinking and thought that these government officials and offices are coming up with. There's no closing that gap. If any, it's just growing over the next decade or two, showing that there's no thought right now on lowering or addressing these debt issues, which is a problem because, as you can see here, it starts pushing the United States down on this list, meaning it's more and more risky. At what point does this then dovetail into the idea that, well, if I'm another country and I now have to choose where I want to put my reserves or my own money, am I going to buy the USA debt that is now, 20th, 26th, however far down on this list, or am I going to find a country that's closer to the top, that's arguably
Always.
more safe, right? And this is something that Alexander and I have been talking about for a very long time, and we're really starting to see these trends accelerate and
Predictable.
continue. Yeah.
We call ourselves slow boiling frogs because all these
Mhm.
things were predictable and they continue to be. What I find really striking, I want to share this with everyone, take a look at China. It's not that far behind the United States. If we went back, maybe next time Paul will show the chart from 2007, 2008. It was way down on the, and it's at an A plus, meaning it's not too far below a double A plus United States. Crazy,
Yeah, that is
crazy.
wild.
All right, let's keep going.
All
And that's
right.
why, you'll see us do some non-dollar denominated
Mhm.
investments for you. Mhm.
Definitely. Good hedge.
Yeah.
LEIs from last month, leading economic indicator. Growth rates stabilized but remains negative, suggesting downward pressure on economic activity ahead. Something to be aware of. When you look at the constituents, right, again, we've been really pointing this out that it has been the S&P 500 that has been driving sort of the LEI over the past, well, really since it's been that rise from a few months, well, from 23 to today, has been mostly driven by the S&P
Stock
500 and
market.
markets, right? And not business conditions, not manufacturing, not services, not new housing permits or anything like that. It's the market. And so is that truly a sign of health of our economy?
Now, interesting thing that I want to speak to here is the fact that housing prices are substantially higher, right? So,
Mhm.
um, and we do not see where that has had any indication of correction at this point. I mean, we'll break down some of the data. I don't know if we did anything on housing in here, Paul, but if you look regionally across the country, yeah, there are certain regions that are having a bit of a pullback, but overall, mm-mm.
Yeah, there's some great resources. I think redfin.com is a sort of an aggregator of national home sale data. And they've got a really cool section where you can look at their charts and really see that housing has not cooled. I mean, yes, it's come down. Certain regions, to Alexander's point, have come down some, but the overall trend is still higher than it was
Yeah.
previous years.
Yeah. It's going to be harder for the younger generation to make it happen for themselves. It's very disconcerting. This is on the mind of a lot of, I've been listening to some interviews with 20, 21, 22 college age kids. This is on their mind. So
Mhm.
this is definitely on their mind as they come out of school. So this is a
Right.
fancy, nice looking chart, Paul. I like the colors
Yeah,
on this one.
it's nice, right? I found this. I thought it
I
was
like
cool.
that all the manufacturing points are right in one chart. This is very nice.
Yep. Yep. And again, anytime that this is below 50, which it is, it's at 47, I think, right now, it signals economic contraction. Above 50 would be economic expansion, and below 50, economic contraction. And we've been solidly below 50, really since 2022.
Yeah.
So,
Yep.
this chart I found very interesting. It just shows that manufacturing jobs as a percent of total jobs have dropped significantly. I don't like how they titled this manufacturing is less important historically, because I think that's missing the mark. But when you look at the trend here, what this is telling Alexander and I really is things like automation, things like developments in technology. These are essentially deflationary pressures, which you can see through this type of chart where manufacturing jobs, the manual labor used to employ way more people than it does today. Now it makes up a much, much smaller portion of the total jobs out there, mostly replaced by service sector jobs.
And obviously internet automation, robotics, like Paul
Mhm.
said. The curious thing is now that we are perfecting automation and robotics, question is, and we do believe that the right side of this line will continue to go
Right.
down in the
Once
downward.
all these AI advances really start materializing in a lot of these industries, we're going to see this compress even
Yeah,
more. Um,
yeah, yeah.
and is that good if you have a economy of people who aren't actually producing anything
Yeah.
other than services?
It's not, obviously a lot of these jobs went back overseas. That's part of the problem
Mhm.
too. I mean, which actually leaves the United States a lot more exposed than
Vulnerable. Yeah. There's a
vulnerable.
fragility from that. Not having the resiliencies at home here
Exactly.
presents a problem where, which we saw perfectly with COVID, when supply
Yes.
chains are disrupted,
Yeah.
it wreaks all kind of havoc. And if we don't have the infrastructure here to make up for that, people get hurt. And that's what we
Yep.
saw.
Yep. All right. Moving on.
Yeah, CRE. So
CRE,
it's that TikTok,
commercial
TikTok.
real estate.
Yeah.
So
Basically that,
there.
yeah.
Oh, I wanted to share this one thing.
Mhm.
So I'm sure, Paul, I think we talked about it, about the building in New York City that sold, what was it? Like 5 years ago for like
130 million or something like that.
150 million, and sold
Yeah.
recently for like 3 million or something
Yeah, I
like
think it was 8, but yeah.
eight. Okay. Well, kind of
Insane.
like
Yeah.
in the single digits,
90% drop. Right.
Yeah. So this is what we see happening in this trend to work from home, is definitely, keeping this on point. But yeah.
Yeah, there's some great charts. There's a service that tracks sort of occupancy rates across major metro areas. And post-COVID, they've really only come back to 60, 70%. Whereas before they would be 90 to 95% occupancy rates, pre-2022. Post-22, it was, huge dip post-COVID, and then slowly arched back up to about 60%. And that's sort of where it's been stuck, it's between 60 and 70 since then. So
Yeah.
that's a
See
problem
that
for
green.
commercial real estate, right? Because they depend on cash flow. And if their tenants aren't renewing space because they don't need it anymore, they need 30% less, that significantly impacts these people's cash flow, which could then lead to defaults on loans, which this chart is starting to show. That
Yeah.
green line is that up now, it's still small overall, which is a good thing, but the direction is what is concerning.
Yeah. It's always about the slope of the curve and the direction.
Right.
for
And you
us.
can see right there, 2022, it's like that pivot point, and then it goes from sort of trending down to all of a sudden, okay, now we're going up. All right, what else we got? Yeah, delinquency on all loans. This just looks at all loans, and rates are still low, but again, it's about the slope of the curve and the trend, and it's increasing. So
Yep.
let's see. I thought this was interesting, Alexander, and maybe we can talk a bit about this. The big thing for Y2K is the great story that you tell is how companies front ran it. Well, they bought a bunch of hardware, updated everything, and then post Y2K, they didn't need to buy anything, and it
Yep.
resulted in this
Yep.
this
That
huge
result.
market that
Yep.
nobody needed anymore, which helped exacerbate the dot-com and all that kind of bubble. What's interesting here is that companies are still projecting, at least until 2025, that their spending intentions, now we don't actually know if this will be actual in what they spend, but generally it's pretty close, but that their intentions are actually near multi-year highs. So that's an interesting tidbit, right?
We'll see how that works out.
Exactly, right. We will see. I thought this was worth including too, because we talk about freight costs a lot. It's still more expensive to ship. It has come down. We would argue, I believe, I don't want to speak for you, Alexandra, that global supply chains have not been fixed, right? There's still ships having to go around Africa instead of through the
Yeah.
Suez. There's still issues with water levels in different canals around the world. This slowdown in shipping rates probably is due to a slowdown in economic growth. There is less demand, and we'll show some charts later around energy costs that also sort of start to pull this theme out, where there is a potential global recession happening, where just demand has been crushed, higher prices and lower demand, and this could be a result where, yes, freight rates are coming down because less people are shipping.
Yeah.
We'll see.
We'll see.
Yeah.
But yeah, it's a problem. And debt. Look
Yeah.
at this.
Yeah, EM debt. So interesting chart, just shows treasury issuance and Eurobond issuance or non-US dollar. They're sort of as interest rates go down, we would expect to see this sort of flip. And so I think it speaks well to our thesis that in non-US denominated bonds might be a good place or a good hedge anyways for the future ahead.
Yep. Next. And we love EM debt, by the way.
Yes.
And we're in EM debt for you. So we already have some emerging market debt, which has done really well for us. Right, Paul? We're up.
Yes,
quite
it
good.
has. No, we're doing
Yeah.
great on position.
Corporate
So here just
profits. Yeah. This is big. Go ahead, Paul.
do you want to speak to it? Okay.
Yeah, I mean, I'll speak to it because this is inflationary right here.
Mhm.
Look at those wages. That's the red line. Okay. That's the red line. That's what's happening. So profits are going substantially higher, which we expect. And here's the interesting thing. In what was it, Paul? 2010, when we passed the Citizens United.
Mhm.
Is that when it happened? And look
Yep.
at the slope of
Yep.
that curve after Citizens United. Citizens United basically gave corporations the same constitutional rights as humans. And here you see that major slope going higher in the face of wages coming down.
Mm. It's
Can you
disgusting,
say
right? It just
corporate
shows.
greed?
Mhm.
It's very disturbing. You know what Paul and I do, we often get like a little conflicted by some of this data because we're like, we know these companies are not behaving properly. And what can we say?
Yeah.
And yeah. And part of that, just so you know, part of it absolutely, like after 2000, you can see the slope of the curve going higher. It has to do with the productivity gains that we got from technology, hands down.
Right. And interesting, they weren't passed to the workers of those companies. And this chart just highlights and shows that point blank. All right. I thought this chart was interesting because we've been talking about the quality of data from certain headline or government statistics has been going down recently. And looking at this chart, it actually looks at survey respondents to all the different government surveys, from jobs to employment to housing to labor turnover, job openings. And you can see something like the what's a good one? Employment cost index, right? 75-ish% used to be the response rate. Now it's below 50.
Yeah.
And then what's the orange one? Job openings and turnover
Yeah.
survey used to be around 70%. Now it's like 33%.
Yeah.
So they're getting back this data. Only 33% of people respond and then saying, okay, here's the headline number. Does that sit right with you?
That's why Paul and I, just so you know, we don't just rely on government data,
Right.
because we do think things get cooked. You know, it just, in the 80s, it became very unacceptable for there to be any recessions. And that's when like a lot of the data started to get, I would say, the manipulation has gotten worse with time. So the CPI, for example, we used to have a basket and it changed, I don't know, 3 or 4 times over the decades. So yeah, yeah. So we engage in other data, not just what we get from the government.
Yeah. Basically, take what the talking heads say with a grain of salt.
Mhm.
All right. So this was an interesting, right? Private sector job growth is below levels pre-2020. So regardless of what you hear out there, these are the actual moving averages of job growth going down, down, down. Fake jobs. Yeah, I thought this was interesting too. This chart just shows total job openings versus actual hires and separations, right? So that dark blue line shows the total job openings, and you can see really post 2020, there's this huge divergence there where total job openings far outranks the total number of hires. And so when we see, when you hear about job openings out there, official numbers, they're really speaking to that blue line. But when you dig into it, you learn that if a job is posted as a remote job, but then they post it in 6 different cities, say Dallas, Boston, Los Angeles, wherever else, each one of those counts as one. So even though it's one job, it has 6 postings at 6 different locations. It
It
counts
counts
as
as
six.
six.
So the
It
the
counts as
surveys and the official headline numbers counted as six. So those numbers are goosed.
It's so funny. All right,
Yeah.
keep going.
Yeah.
It kind of it's just as somebody who's been in the industry for 38 years, it's just gotten worse with each year, and you're sitting there going, like we're slow boiling frogs. You know, this is it
Yeah.
was where we were headed and where we are today has been so predictable, and this is why, and because it's like we're being gaslit
Mm.
as a society. You know, we're being told one thing, but the truth behind the numbers is something completely different. And
Really
the
does feel like
experience
that.
of people is yet even completely different. So, you know, yeah, let's get real. That's where we are. Let's get real. Yeah. And it's been going on for decades, you guys. So this isn't just like a, you know, today thing. It's a bipartisan problem.
I feel it's very in our faces today, more so than in the past. So here's a just quick chart of the Strategic Petroleum Reserve, which has been in the news lately. It's slowly been being refilled, but it's still, half of what it was pre-2020, with concerns really around what does this mean? Has this what's been artificially keeping gas prices low? If they keep drawing from this, how long can they do that? And then what's it going to cost to refill it? I've even read that it's not possible to refill some pieces of it due to the structural integrity of the caves or whatever that they use. So
So I just want to speak to the importance of the SPR. This is our safety net. This is our safety net should we go to war, which we all know is getting very close now. Let's be honest. Unfortunately and unnecessarily, but uh, if you look at this since 2021, the drawdown has been so significant. We're looking at time periods back to the 80s, okay? The early 80s, Cold War, think Cold War, right? And honestly, right now, to have reserves this low puts the US at risk. When we're talking about manufacturing and having to get a lot of our parts from overseas, this is called national security, is what this is called. And we are more exposed now than we have. Lower rate on our bonds, high debt, less manufacturing, SPR lower, our employment lower, illegal immigration much higher, so a tax to the system. It's a lot. We're dealing with a lot, and I feel like Humpty Dumpty has a couple cracks in it. So we just don't want Humpty Dumpty really like falling apart here. Let's be honest. This is
Hope
what
not.
Paul and I see on a daily basis. So the truth is, for Paul and I, our biggest job is to stay as defensive as we make money and stay as defensive as we possibly can in that process for you. So understand, this has been going on for a long time. This isn't just like, boom, it just happened. No, this has been going. It's crazy to watch it.
Yeah, so this is the chart around interest rates. And what's really concerning here is this is 10 years. In 10 years, the interest we pay on our debt has tripled.
Yeah,
And you
so
can
the
see
US debt.
that rate of change has been going like this. And due to cumulative compounding, this risks going exponential. I mean, it's already in process of that, but we're still, at that beginning stage. But at some point, right, every time something doubles, and this
And
is
it,
showing that we're there. And there's no political will on either side that I've seen about addressing this.
yeah.
And that is what gives me a lot of concern.
Exactly.
Yeah.
Paul and I try to stay very like in the middle of the road around
Mhm.
politics, because our job is to look at data. Our job is to look at behavior. Okay. And data and behavior gives us an indication of where we're headed, and in that neutral territory, we can clearly say this is bipartisan. We're spending like mad dogs here and having a good time at it. But now having to pay this interest, it's just that is inflationary. It is inflationary. Yeah.
And I forget what the number is if you were to break down $1, like how much of it goes to servicing debt. But at
Oh, it's
what point, when you pay your taxes, to know that 50, 60, 70% of that is going to pay interest and not going to better our economy, better our infrastructure, better our country, that should raise a lot of eyebrows. So here's just some charts I pulled in, Alexandra. I think this will be fun. Yeah. So this looks
big
at
is getting
the,
bigger.
yeah, big getting bigger. So this looks at market weight versus equal weight. The trend still looks very much intact. Um, yes, it's pulled back a little bit, but it still looks to me that big is going to continue getting bigger here. And those
Yeah.
large cap companies are going to continue to dominate while smaller caps suffer.
And we're positioned in large cap.
Mhm.
We did a
Yeah.
pretty sizable pivot recently. We'll explain in a second.
Yeah.
Think it's getting
Yeah.
bigger.
And this is just large cap versus small cap, just to show that that trend is still intact. It has not deteriorated yet. What we'd want to see in a very healthy economy is this sort of go the other direction, because it means that those smaller companies are really thriving and really producing, but we're not seeing them, right? You want that rising tide to lift all boats, not just the biggest boats.
And
Right.
they say the generals don't win the war.
Right. Exactly. That's a great saying.
Yeah. That's an
Gold.
old one, Paul. You never heard that one?
No, I haven't. No, but I like
Yeah.
it. Yeah. Here's just gold. Again, flight to safety. Were we in a booming economy, you wouldn't see gold hit new all-time highs. It
You
historically
won't
is
hold.
here. Right. We have a nice position here. We like it. Um, it's an interesting ratio, copper to gold, but basically when it goes down, it's saying that there's more people buying gold than copper. Copper can be used or thought of as sort of like a proxy for
The economy.
economic growth, because you need a lot of copper to build wires and all kinds of different components of a growing economy. So when you see this ratio shift and this chart go up, it says that copper's doing well, which could be thought of as the economy's doing well, and less people are buying gold, so they're less worried about uncertainties of the future. When you see it go the other way, which it's going down, it says that there's less focus on that copper and growth there and more focus on a defensive gold position. So,
Which we're in. More defensive.
yep.
Oil and energy.
Yep. Oil and energy. Again, what I derive from this chart, and Alexander and I, we've spoke about this too, is if it was a booming economy, there would be huge, and there is huge demand for energy from the AI and all that kind of stuff. But energy is not hitting new highs because when you look at things like gasoline and other statistics around energy consumption, it's not there. It's not showing up. When China reopened, there was supposed to be this huge boom in demand for oil and energy was supposed to skyrocket, never showed up, never materialized. And so we're seeing that in this chart, it's just kind of floating in the middle there sideways. Nothing's really happened. You'd want to see movement here, right? If this continues to deteriorate, again, it's one more confirmation that, yeah, we're straight up in a recession.
Yep. This is tough.
Mhm. All right.
Okay. So
That's
let's
our
just
chart
talk
back.
about how, I want to just talk about how we're
Yeah,
positioned, Paul, because we don't really
absolutely.
have any questions that came in.
Yeah.
Somebody did ask about annuities, but they're not here, so we can address that with them specifically.
Yep.
Just so you know, what Paul and I have done over the last few months is we've noticed that there's been, this is about 3-4 months ago, we noticed you were in quite a few technology stocks, and we noticed that there was a shift from that more like growthy oriented companies into more of the stable companies like utilities and REITs and healthcare and products that we need. So we've done a pretty a little bit of a shift, not a complete shift, toward things that are a little bit safer. We haven't been there in a long time, but we're there. Things we haven't bought a utility in 5 years, Paul, 6
Yeah.
years? I don't even
Right.
remember. But you're in some utilities. You're in some real estate. We haven't bought real estate in
Long time.
long
Mhm.
time. Yeah, 5-6 years, same thing.
Yeah.
So there's been a shift. It's working out to your advantage. We bought some hedges in you still have your cryptocurrency. It's done very well for you. Not really great over the last 2 or 3 months, but we're up a lot. So we would have very large capital gains if we sold there. We have gold as a hedge. We have been buying like non-dollar denominated assets as a hedge. We think this is the right place to be going into this election season. No matter where you sit on this fence, no matter what side you're on, we know this is not an easy time for our country. So bifurcated, and there's just so much turmoil, and that doesn't speak to like what in our mind a lot of safety. So we have things that are actually our new positions are actually outperforming the technology sector right now, and that's what we want to see.
Mhm.
Anything you want to add to that, Paul?
Yeah, just that being defensive right now, based on all the data that we see, makes a lot of sense. And one of the topics, maybe we beat this with to death, but around social cohesion, right? And this election, I mean, we haven't seen this improve, unfortunately. If anything, we're seeing more divide, more aggression, more discontent between different groups and less cooperation. Ultimately, that can spill over to social upheaval, all kinds of issues that generally markets don't like, right? They introduce volatility. It just the risks here are much higher than they've been in the past. And so we feel taking a more defensive position with the portfolio at this time makes a lot of sense.
Yeah. All right. That's a wrap. I'll be in the office in a few minutes, Paul. I'm leaving here.
All right.
I'll see you in
Sounds
a few
good.
minutes.
All right. Thanks,
Okay.
everybody, and take
Bye.
care. Enjoy
Bye.
your week and enjoy the fall.
Yeah.